It's Scott, professor of new home sales. I'm here today with Tish Ashley, the guru of mortgages. We're going to talk a little bit today because things are changing, right? And we want to talk a little bit about that. But first, before we do, let's kind of build some background on it. So tell me, who is Freddie Mac and Fannie Mae? Like, are those some uncles or cousins that live down by the river, you know?
Yeah, long ago this happened.
I don't know how they came up with Freddie Mac and Fannie Mae.
I honestly don't know the history of the names. I'm going to look that up today now.
Okay.
That's kind of fun trivia. They're actually what we call GSEs, government-sponsored entities. And what their role is to keep the mortgage markets liquid.
Okay.
So a lender like us, we're a direct lender to Fannie Mae, for example, or Ginnie Mae. So that's the other one you didn't mention.
Oh,
But
sorry.
same concept.
Okay. Cousin Jenny.
Cousin Jenny,
Yeah.
she's a favorite
Okay.
auntie.
Uh-huh.
But what happens is we'll go and lend money out on, hundreds of millions of dollars worth of loans in any given month. And then we will turn them and securitize them to the secondary market, which is Fannie Mae, Freddie Mac, et cetera, to free up those funds for us to lend again another day.
So when you say securitize, you're saying you're going to sell it.
Yes, but it's a little more complicated than that. It's going to be turned into a security bond, a mortgage bond. You've heard of mortgage-backed securities.
Correct.
And those are actually ultimately funded by people out there all over America that participate, for example, in 401ks. If you go digging through your 401k, I'm almost certain you're going to find some mortgage bonds in there to help level risk.
Right. Okay. All right. Very good. All right. So now Freddie Mac and Fannie Mae and Ginnie, they're all together.
Yeah.
So
they're at the beach somewhere.
Okay.
Or Wall Street.
So
or Chicago.
Now, in terms of who we lend to today, right? Obviously, there's different statuses, as you were, right? You can be an American citizen,
yes,
right? And as far as it goes for lending for American citizens, all programs are out there, exist, right?
Yes, I think you're talking about eligibility for a given
eligibility,
loan program.
okay.
It's a difference between an eligibility versus an approval. Yeah.
Okay.
American citizens are eligible for any loan type that's available in the market.
Okay.
And green card holders or permanent resident aliens are also widely able to get mortgage money that's going through the agencies.
So a green card holder is somebody that's a permanent resident but hasn't reached the status of becoming a citizen.
Correct.
Yet, right?
Correct.
But they're
could, permanent.
Right, but they could be in the process if they wanted to.
Yes, and
become
most
a citizen.
are actually.
Right.
Yes,
okay.
Most are.
All right, so then you have green cards, and from there then, is it visas?
You get into the temporary or non-permanent residents, which a lot of them are working to become permanent residents, and they're very legitimately here. They're here working on EADs, employment authorization documents, or on H-1B visas, or there's a whole myriad of visas available.
Right.
And
that's like if you're going to school, or if you have a specific job.
Correct.
Or a specific career.
Yeah, and sometimes a lot of these types of visas are being sponsored by large American corporations, and they've gone and gotten these workers brought in, whether they be intellect workers or whether they be physical workers or whatever.
Okay.
And they brought them here and sponsored them here, and they qualify still. Most of the visa types that are legitimately here and have some longevity to their stay will qualify for a Fannie Mae or Freddie Mac loan.
Okay.
Right now, they also qualify for FHA loans. But that is changing. In May of this year, I think it's May 25th, that if your case assignment for an FHA loan is not yet assigned, and that is specific to a house, to a person, a social security number, all of that, if it hasn't been assigned by that date, you must be a green card holder or permanent resident alien or a citizen to use FHA financing.
That's just FHA.
That's FHA. USDA has done something similar, but that's such a small market comparatively.
Right, exactly. And then from the standpoint of conventional, right now, everything is okay with conventional from the standpoint of those visas holders being able to get a loan.
Yes, as long as your standard of proof on Fannie Mae or Freddie Mac right now is just that you are legally here working and have a visa type that has some longevity to it.
Okay.
Putting it very, very simply.
All right.
And Fannie Mae has not announced any changes.
Okay. So in terms then of what's ahead of us, it's in the end of May. So if people are out there and they're a visa holder right now, and by the end of May, they can still buy a house via FHA.
That is correct. And they all they have to do is contract for it. I would recommend getting through any inspections or anything like that prior to May 25th. They don't have to close by then, though. Once a case assignment is pulled, they've got up to 6 months. So if somebody came to you and wanted to build
a
right
house.
now,
Right.
you just need to pay attention to, okay, we'll pull the case assignment the week of May 20, and then you need to be finished within 6 months so that they can close. Otherwise, a new case assignment has to be pulled.
Which is easy for us to do in terms of the 6-month turn time.
Sure.
On a house, yeah.
Sure. But if they're in that situation and they know that FHA loan will accommodate them better,
Right.
I would recommend that they get out there and get serious about looking for a house now.
So if you're a visa holder, things are changing for you. You're going to lose one of the options, which is the FHA loan. So if you're out there and you want a home, it's now more than ever, it's time to buy.
It's time to buy.
Things will be changing. Whenever you talk with Tish, she's always looking for a new angle, a different way to get somebody qualified. And we talked a little bit about moderate income. So a moderate income might be $70,000, $80,000 in that range. And there's a new program out with 3% down or new offering.
Fannie Mae has, in its commitment to try to help more people become homeowners, they've got this program called Home Ready. And Home Ready is income balanced, but it has the ability for somebody, even if they already own a home or have owned homes in the past, to be able to get in with just 3% down, which is nice because sometimes, let's say, a lot of homeowners, current homeowners, are equity rich right now.
Right.
There's
Absolutely.
a lot of equity sitting in their homes, but they're cash flow poor because, let's face it, the average person in Texas has about $20,000 in credit card debt. And they don't know how to get out from under that at 20% interest, et cetera. It's hard. It just sits there and cycles and cycles. The only way out of revolving debt, the only way, is lump sum payments well beyond the minimum payment required.
Right.
And that's by design.
Right.
But we've been seeing situations where people sell their existing home. We help them structure to figure out how to get rid of the revolving debt, and then they're eligible to go into this with 3% down. And if they don't fit the income limit, then 5% down.
Right.
But either way, with the equity, we can completely turn around their personal financial situation, even if they just make a lateral move.
And get into a brand new home.
Brand new home, which is less expensive to live in.
And less expensive to insure.
All the things.
All the things. And more importantly, even though their payment might be higher on that new home, accumulatively,
Total monthly cash flow.
they're going to pay less. And the most important thing, at least from my perspective, is they're going to save money on taxes because now they're going to be able to deduct the interest and the property taxes, right?
Right. You get to deduct the property taxes up to $10,000 because Texas is a SALT state, and they'll get all of the interest to write off. Plus, it opens up on Schedule A other types of write-offs that they wouldn't have been able to get to if they were taking the standard deduction.
Right.
Now, I'm not a CPA.
No.
I have to point that out.
Yes, okay. Please consult your CPA.
Correct.
Individual.
Correct.
Okay,
Yeah.
Very good. Well, that's Tish's new toy, her new program for today. Thank you for the Mortgage Minute. Remember, share, like, comment. We appreciate it. Right. We've given a lot of veterans new homes and generated loans for them. So veterans are very near and dear to our heart.
Yes.
We love veterans. We love doing veterans loans. So let's talk a little bit about how the veterans loan work. And also, if you could share, I know sometimes depending on the rates, the Texas Veterans Land Board is really the way to go. So tell us a little bit about Veterans Land Board.
So Texas Veteran Land Board works specifically for Texas vets, as it would imply, and it lets them go in with a 0% down, just like any other VA loan would allow.
Okay.
But they set and post rates every week, and those rates are in place from Monday till Friday.
Okay.
And then turn it off no matter what the market did during that week, and they start with a new rate on Monday.
So like, for example, today, what's the rate for that?
The Texas Vet Board is 5.95 is the regular rate, and with the disability rating, it automatically takes 0.5% off that rate and posts it at 5.45. And
that's on a 30-year fix.
That's a 30-year fixed rate.
Wow,
Yes.
that seems really point or more than below par.
Yeah.
Right.
Yes, in some weeks it's more favorable than others depending on what's happened in the market during that week, but it's always something that should be considered for a veteran.
Okay, always look Texas Veterans Land
Yes.
Board.
And if they just post that rate, and the rate is the same across lenders, the difference here is we're going to compare Texas Vet in that moment to the actual veteran's needs on a regular VA and determine how can we get them to the lowest cost mortgage.
But is it 100% disabled vet that gets a half point lowered, or there's a sliding scale there?
It's not a sliding scale. If you meet their requirement for disability, you're there. But if you are a 100% disabled veteran, we thank you so much for your service, and you get some extra goodies in that you don't have to pay property taxes.
Right.
And so we can qualify a 100% disabled veteran without accounting for property taxes and the debt to income ratio, which can be a deal maker.
In the state of Texas. I've heard in other states, they don't do that.
Nope. Yeah.
I mean, so the state of Texas, if you're a disabled vet, you get 100%.
That is true. You can go to the Attorney General's website and you can see the posting that gives you that as a right.
All right, so we've had some Texas vets relocating from California and other parts of the country. So if they come in and buy an inventory home and I'm going to give them 3% towards closing costs, right?
Yes.
Will the Texas Veterans Land Board necessarily be the best way to go, or what would you suggest?
No, it probably in that situation where there's 3 points to work with, and if they're coming from another state, they're going to have to land in Texas first.
Right.
So, but a regular VA loan would be very attractive for that veteran, and if they needed it to get in with $0, that would be one way to do it because you're supplying all the money for closing costs, prepaids, insurance, all of those things. Or if they're like, I've got a little money in my pocket, we could take your 3% and we'd only actually need roughly 2 3/8% of it,
right,
and get them on a 2-1 buy down. So they may start at a 3.99 or a 4% rate.
Wow.
Just depending on the day in the market.
So it'd be 4, 5, then 6.
That's the idea of the 2-1 buy down.
Yeah.
Yes, it gives them 1 year at 2% below whatever their rate is, 1 year at 1% below whatever their rate is, and then years 3 through 30 at that rate, unless there's an opportunity to do what we call an IRRL, IRRL,
okay,
interest rate reduction loan, which we believe that in the coming years there's going to be opportunity where these veterans that were on a 2-1 buy down may never even see that 30 fixed rate because there will be an opportunity to refinance into a lower rate permanently.
Right. What's an IRRL again?
Interest rate reduction loan, IRRL.
Okay. Well, if you have more questions for as you can tell, bringing up acronyms and things like that is out of the air. It's our Mortgage Minute for today. We love our veterans.
Yes, we do.
Thank you for your service. If you're looking for a mortgage loan, come see Highlands Residential Mortgage. Come see Bloomfield Homes.
Yes.
We have something for you.